Okay, let's talk about a real head scratcher. How can a country have the world's fastest growing major economy, a stock market that's hitting all time highs, and yet its currency is in a complete nosedive? It's a massive contradiction, right? And it's happening in India right now. So let's break down this paradox. To really get what's going on, you have to see the two completely different stories playing out in India's economy. And let me tell you, on the surface, they make absolutely no sense together. And this really lays out that contradiction perfectly. On one side, you've got this powerhouse economy. We're talking an incredible 8.2% GDP growth. But then on the other side, the Indian rupee is in an absolute freefall, becoming Asia's worst performing major currency. So how can both of these things possibly be true at the same time? Now you might be thinking, okay, this is just a problem for traders and big corporations. But a weak currency actually has a direct and pretty big impact on daily life for hundreds of millions of people. Here's how it really affects you. A weaker rupee means that anything imported, from your phone to your car, is going to cost more. And crucially, it hits you right at the gas pump. See, India imports about 85% of its oil, so a falling rupee pretty much guarantees rising fuel costs for everyone. Now, there is one upside. It makes Indian-made goods a whole lot cheaper for the rest of the world. So that brings us to the core question, right? If the economy is so strong, why is the currency so weak? Well, the answer isn't simple. It's more like a combination of a whole bunch of factors hitting all at once. There isn't one single culprit here. Instead, what we saw was the rupee getting caught in a perfect storm of really powerful forces, both from outside India's borders and from within. So, let's start with the global picture. You had the US hitting Indian goods with heavy tariffs. Then global oil prices spiked, which of course hits India right where it hurts. With all this uncertainty swirling around, foreign investors started getting nervous and began pulling their money out, moving it to what seemed like the safer US dollar. Now, to understand that last point, we need to talk about something called FPI, or Foreign Portfolio Investment. The best way to think of it is as hot money. These are international investors who are putting money into a country's stock market to make a quick profit. But here's the thing. Just as quickly as it flows in, it can flow right back out the second investor confidence starts to waver. And this is exactly what happened. It created a chain reaction. First, those spooked foreign investors sell their Indian stocks. Then, to take their money out of the country, they have to sell their rupees and buy US dollars. This sudden massive demand for dollars makes the dollar stronger, and by simple supply and demand, the rupee gets weaker. It's a really vicious cycle. But it wasn't just global headwinds. India was facing internal pressures too. There's that huge dependence on imported oil and electronics. Then you have political uncertainty from constant elections, which always makes investors a little nervous. And finally, a growing middle class is buying more imported luxury goods, and all of those have to be paid for in dollars. What's really interesting about this slide is just how stark it is. This chart basically shows India's single biggest economic weakness. That huge slice of the pie, 85%, well, that represents the country's dependence on imported crude oil. This is what makes the entire economy incredibly vulnerable to global price shocks and, of course, currency fluctuations. So, with the currency in a free fall, the natural question is, where was the central bank? Why didn't the Reserve Bank of India, or RBI, step in more forcefully to stop the slide? And in fact, that was exactly the feeling on the trading floors. A lot of traders felt the RBI was just sitting on its hands, describing the central bank as unusually absent, while the rupee just plunged deeper and deeper. But that wasn't really the whole story. See, behind the scenes, the RBI was intervening. It just did it quietly, selling a record $38 billion from its reserves. The goal wasn't to completely stop the fall, but to slow it down, to prevent a total chaotic crash. This put the RBI in a huge bind, okay? Option 1, go all in. Burn through billions in reserves to save the rupee. The big risk there? Leaving the country totally vulnerable to the next crisis. Then there's option 2, just let the rupee fall. Yeah, it's painful now, but it has a massive upside. It makes Indian exports much, much cheaper for the world to buy. And that's the path they chose. Instead of drawing some line in the sand at, say, 88 rupees to the dollar, they went for a limited intervention. Basically, they managed the decline to prevent shocks, but ultimately allowed the market to find a new, natural level for the currency. So this leads us to the final, and maybe the most fascinating part of this whole story. Could this painful currency crisis actually contain the seeds of a massive opportunity for India's economy? So what's the long-term fix here? Well, experts point to deep structural changes. It means boosting programs like Make in India and its production-linked incentives to manufacture more at home. It means shifting to exporting high-tech electronics, not just textiles. And it means attracting stable, long-term investment, not just that hot money we talked about. And here is the potential silver lining in all of this. For all the pain it causes with imports, a weak rupee is a powerful stimulant for exports. All of a sudden, products made in India are significantly cheaper for buyers in America, Europe, and pretty much everywhere else. This situation has led some analysts to ask if this could be India's China moment. See, for decades, China intentionally kept its currency weak to make its exports absolutely unbeatable in price. And that strategy was a key pillar in transforming it into the world's factory. So, the final question is this. While India's currency has weakened because of market forces, not deliberate policy, could the effect actually be the same? Could this crisis be the unexpected catalyst that helps India finally realize its potential and become the next great global manufacturing hub? Ultimately, the path to becoming a $10 trillion economy isn't just about headline growth. It's about building a resilient economy that can actually withstand these kinds of shocks. The pieces are on the board for India to turn this crisis into a historic opportunity. The only question is, will it seize its moment?